Welcome to Mauuak Saving Tips. In today's rapidly evolving financial world, artificial intelligence is reshaping how we invest. Once dominated by intuition, relationships, and manual number crunching, the investment landscape is now guided by algorithms that sift through terabytes of data in milliseconds. Investment AI, the marriage of machine learning, natural language processing, and cloud computing, has completely redefined how we spot market trends, quantify risk, and capture alpha. This isn't a futuristic concept anymore. It's a proven shift that is already generating tangible outperformance for investors who are willing to embrace technology. AI's edge lies in its ability to collect and analyze information from a dizzying array of sources' earnings calls. SEC filings, satellite imagery, shipping manifests, web traffic, and even the tone of CEOs' voices during conference calls. It then converts this alternative data into actionable signals faster than any human analyst can refresh a spreadsheet. Recent research from Deloitte shows that hedge funds deploying AI models have beaten traditional managers by an average of 2 to 3 percentage points per quarter since 2020, and a handful of fully autonomous funds have compounded more than 20% per year for 5 straight years. Yet the everyday investor still faces steep hurdles: non-stop volatility, media noise, and the paralysis that comes from too much data. Studies from FINRA reveal that 74% of retail traders admit they made impulsive trades driven by fear or FOMO.
Holy.
17% systematically backtest their ideas. AI flips that script. It screens out false signals, monitors thousands of tickers around the clock, and delivers real-time dashboards that highlight only statistically significant insights, turning analysis paralysis into calm, data-backed conviction. Importantly, AI isn't reserved for Wall Street giants anymore. Low-cost robo-advisors such as Betterment and Wealthfront use modern portfolio theory plus machine learning rebalancing to serve everyday investors for under 25 basis points. Brokerage apps now embed AI-powered options scanners, ESG scoring, and tax loss harvesting that automatically execute trades in fractions of a second. Even conservative pension funds are using deep learning nowcasting to stress test portfolios against climate risks, cyber threats, and supply chain shocks. For a vivid example, consider Renaissance Technologies' Medallion Fund, which ingests more than 1 million price series and writes thousands of microtrades daily. Its proprietary AI models detect patterns that last mere seconds, yet they've produced legendary, market-beating returns for decades. It's another case. A solar infrastructure ETF partnered with an AI climate analytics firm to overlay satellite heat maps on plant-level production data. The algorithm pinpointed underperforming solar assets, prompting timely maintenance that increased annual energy output by 8% and boosted dividends without adding capital expenditure. That said, investors must remain vigilant. AI models are only as good as the data they ingest. Biased or incomplete datasets can lead to misleading signals. Black box algorithms may also trigger unforeseen feedback loops. Remember the 2010 flash crash. Regulators are catching up, with the SEC, ESMA, and MAS drafting guidelines on algorithmic accountability, model explainability, and cybersecurity. Responsible investors now pair AI insights with human oversight, rigorous backtesting, and scenario analysis to ensure robust decision-making. Looking ahead, quantum-enhanced machine learning, synthetic data generation, and reinforcement learning agents trading across multiple asset classes in real time will further raise the bar. AI won't eliminate risk, but it will dramatically shift the odds in favor of disciplined, tech-savvy investors. Embracing these tools today means positioning yourself for the data-driven markets of tomorrow. As AI continues to mature, we're re-entering a new era of hyper-personalized investing where machine learning tailors financial strategies based on your goals, income, risk tolerance, and even behavioral tendencies. Imagine an AI that not only tracks your portfolio, but also learns from your past decisions, predicts how you might respond to future market swings, and proactively suggests adjustments to keep you aligned with your long-term vision. This is no longer science fiction, it's becoming standard across next-gen platforms. Behavioral finance, once a purely academic field, is now being operationalized by AI. Advanced systems can detect patterns of panic selling, or confidence, or herd mentality in your trading habits, and intervene with smart nudges or temporary trading blocks. This behavioral-aware AI is particularly valuable for millennial and Gen Z investors. who often enter markets via mobile apps and face constant temptation to chase trends. By recognizing emotional triggers in real time, AI acts like a digital coach, helping you avoid the classic traps that erode returns. In institutional settings, AI-driven portfolio optimization is being revolutionized by deep reinforcement learning. These models don't just backtest strategies, they simulate thousands of future market scenarios, learning and adapting with every outcome. This gives asset managers a powerful edge, the ability to dynamically rebalance portfolios based not on static rules, but on evolving macroeconomic data, geopolitical shifts, and even weather events that may impact global supply chains. AI is also playing a critical role in ESG investing. It can analyze sustainability reports, NGO databases, regulatory filings, and social media sentiment to assess whether a company is truly green or just greenwashing. Investors focused on impact and ethical returns are increasingly relying on AI to sift through the fog and uncover which companies align with their values. And let's not overlook the rise of AI-powered sentiment analysis. Platforms are scanning millions of tweets, Reddit threads, analyst calls, and earnings transcripts to gauge the emotional temperature of the market. These tools don't just tell you what is happening, they tell you how investors are feeling about what's happening. This is crucial in today's meme stock world, where social momentum can move prices as much as fundamentals. Looking to the future, AI and blockchain are converging to create entirely new investing ecosystems. Smart contracts will allow AI systems to autonomously execute trades, manage dividends, and rebalance portfolios across decentralized exchanges. Think of it as the self-driving car of finance, a fully automated wealth engine that operates transparently, securely, and 24/7 across global markets. Yet with all these advantages, human insight still matters. The best outcomes occur when human judgment and artificial intelligence work together. Investors who understand the strengths and the limitations of AI will be the ones who thrive. They'll know when to trust the machine and when to step in with intuition, experience, or ethical judgment that no algorithm can replicate. To sum it up, AI is not just a tool, it's a competitive advantage, a personal assistant, and a risk manager rolled into one. It empowers you to invest with greater speed, clarity, and discipline. But like any powerful technology, it demands responsible use, continuous learning, and a willingness to evolve your strategy as the landscape changes.